Viewers, summer comes earlier and earlier every year. No, I'm not talking about climate change here in Houston. I'm talking about the very normal consumer discretionary and durable goods slowdown that has hit several stocks very hard the last few weeks. This is on the back of the calendarizing, the positive COVID purchasing effect that we had a year ago, as well as some supply chain bottlenecks beginning to ease. I'm Chris Perras, Chief Investment Officer at Oak Harvest Group, and this is our investment team's midweek release when we examine a news item, headline, or story making the rounds from publicly available sources, and we ask, is it news or is it noise? This week's topic is the headline news of a looming consumer goods-led summer slowdown. Why is this news? It's news because now the press is catching on to what we've already been talking about for months. What's that? That's the rate of economic growth having peaked and likely slowing through the coming months in the summer of 2022. This is largely led by a peak in consumer goods spending while consumer service spending upticks. Does this mean it's time to panic? Does this mean it's time to call your advisor and sell your entire portfolio of stocks, which is supposed to be a tool for long-term financial planning? No, not if you're in a diversified portfolio. Some hard data series that confirm what we had already been saying. Broad data, like the Philadelphia Purchasing Managers Index, showed new orders peaking and missing estimates at a reported number of 17.8 versus an estimate of 25.8 in March. This is at the exact same time inventory data rose to 11.9 reading versus a 0.5 reading in March. This shows a broad inventory build as demand slows. That's bad for the rate of change in summer economic growth here in the United States. Used car demand is plummeting. How many times do you buy a used car during a pandemic so you don't have to ride on mass transportation or take an Uber? Housing demand is slowing as higher mortgage rates are choking off speculators and spring home buyers. iPhone and home computer sales are starting to slow. But viewers, believe it or not, this is very normal at this time of the year and is much needed. Why? Because these things and demand for these goods were the first signs that led the upturn in inflationary impulse in pricing the last 18 months. Slowing demand for these goods should be the first and earliest indicator that inflationary forces in our economy are starting to peak. I repeat, starting to peak. And remember, viewers, the markets care about rate of change as much, if not more, than they care about the level. Recall, viewers, the equity markets rocketed higher in the second quarter of 2020 against most strategists and commentaries' projections as the economy went from disastrous on the COVID lockdowns to merely horrible in 2020 and continued much higher throughout the fourth quarter of 2020 as it then went to just bad. Yes, inflation momentum, that's the rate of change, looks to have peaked. Oil prices, while high, continue to hover around 100 to 105 per barrel, not the 200 per barrel many projected as Russia invaded Ukraine. Shipping container rates are down almost 30% from the peak in late 2021. Used car pricing has declined -2% and -3.5% the last 2 months, and used cars make up 4% of the CPI, believe it or not. Anecdotally, I'm seeing more meat specials on the weekends at my butcher. I can find brisket at half the price of only last summer now. There were Easter sales of $3.50 to $5 a pound for bone-in prime rib. These specials were non-existent 3 to 9 months ago. Does that mean the coast is clear? The Federal Reserve will stop talking hawkishly and you can buy anything and everything in the stock market? No. However, it should mean that if you're a diversified investor owning a little bit of everything, some growth stocks, some dividend stocks, and some boring, higher yielding, low growth stocks, you and your portfolio are probably going to do better in the second half of 2022 than you did in the first half of 2022. Are your equity accounts up year to date? Doubtful, unless you're a 100% undiversified energy and commodities investor or trader. Is it off to the races again? That's highly unlikely. As we have tried to stress since last November, that's not what the first few quarters of 2022 should look like. Unfortunately, it should remain a sloppy, choppy mess in the overall stock markets through summer. However, these stories of cooling used car demand, slowing housing sales, and peaking shipping rates are definitely news to your investment accounts. Why? Because these are a few of the leading things needed for inflation to peak, the Federal Reserve to cool their interest rate increase talk, and lower sustained volatility to return to the overall markets later in the year. Viewers, feel free to give us a call here to speak to one of our advisors. Let us help you craft a financial plan that meets your retirement goals and your needs first and your greed second. Give us a call here in Houston at 877-896-0040. We're here to help you on your financial journey into and through your retirement years. I'm Chris Perras, and from everyone here at Oak Harvest, have a great week.